Hey guys! In this video we're going to take a look at how to pick good stocks to invest in by doing fundamental analysis on a stock, a form of stock analysis where we try to value stocks to understand if they're good to buy or not. And in this first video on fundamental analysis, we're going to begin by taking a look at the global situation and the situation in the country where the company operates. Simply the macroeconomic situation where the company is active. This video is going to be part of a series on how to do fundamental analysis on a stock, so hit subscribe and the bell to grab this opportunity to learn how to pick good stocks to invest in and not miss out on the rest of the videos in this series, where we're going to take a closer look at first the industry and then the numbers of the specific company. If you really want to learn how to properly do fundamental analysis on stocks, then this video series is going to be for you. So grab a pen and paper and let's get started. The value of a stock today is dependent on expectations of the future earnings and possible future dividends. By performing a fundamental analysis, we want to try to find stocks that are undervalued. So when analyzing the company, we want to determine the real or fair value of the company and then compare this to the stock price. If the stock price is less than our fair value, then the stock is undervalued and we should buy it, of course. If the stock price is more than our fair value, it's instead overpriced and we should sell it, or at least not buy it if we don't own it already. When trying to analyze a company to obtain a fair value of a stock, we can look at the numbers of the company. This can be key figures, for example, such as the PE ratio, or take a deeper look at the firm's accountings. But then there are some more qualitative things that will impact the future earnings of the company as well, and thus the fair value of the stock, that are not as easy to put a number on, but are equally important. And the fair value of a stock is of course dependent on how the world or the global situation is at the moment and how we believe that this will be in the future. It's probably pretty obvious by now from the current situation that a company's earnings will be affected by what's going on in the world. And it's a good idea to start a fundamental analysis here to be able to pinpoint where to look for good stocks at the moment. If we look at the current situation, we can see that some industries have been hit harder than others, for example the airline industry or the travel industry. And other industries have instead gained from the current situation. Some of the big tech companies have been better off when people have been staying at home using different internet-based services more. And in addition to these world-spanning events, we can also look at how the political situation is in the world. Politics can of course affect the stock market when the conditions for companies are changed that will affect their future earnings. Look at the reaction of the stock market to Brexit when Great Britain decided to leave the EU, or the trade conflict between US and China, or when Trump tweeted something. Most importantly, the stock market doesn't like uncertainty. The stock market likes clear and concise rules, so it's good to have a good idea of what's going on in the world and consider how this will affect the firm that you want to invest in. Then it's not just the global situation we should look at, but also the situation in the region or country where the firm is operating. Is the region or country stable, for example? Even if many believe, for example, that Africa will grow faster in the future than many already more developed regions, there are several countries in Africa that have a very politically unstable climate with high levels of corruption, for example. First and foremost, a firm will not want to establish themselves in a country where the political climate is too unstable. To start up or establish a firm, there is a certain degree of long-term stability needed, and if the rules can unexpectedly change without warning, it's not going to be worth it. Already established firms are not going to be able to make as much money either if they have to pay for bribes, for example, or if they all of a sudden get taxed in a completely new way. In a more stable country, it will be easier for a firm to both start up and establish, and for existing firms to generate profit. And it will also be easier for us investors to do the analysis and try to forecast the future earnings of the firm. Another thing that will affect the firm's opportunity to future earnings is the monetary policy and the subsequent exchange rate of the national currency against foreign, especially to firms that are dependent on export, but also for those dependent on import because some components or raw materials may be needed to produce the end product. A stronger dollar, for example, means that US companies will have a harder time competing on the global market with their products. If their product, say, costs $100, then the product will be more expensive. Say in euros, for example, if you have to pay $1 for €1, then say $1 for €2. In the first case, the product will cost €100 as well, but in the second case, it will only cost €50. But for the firm that is dependent on import, their money will buy more components or raw material abroad if the dollar is stronger. Then they will get, for example, more euros to buy for. But often a company is both import and export dependent, especially in smaller countries that are more dependent on the rest of the world. In the short term, the firm can hedge against changes to the exchange rate by buying currency options or currency futures, but long term, this will be harder. If a firm writes a contract today on buying or selling a product to a foreign firm, when the delivery and payment will happen in the future, they can sort of insure themselves to get the same exchange rate for the transaction at the payment as it is today, without risking it to be less and be less dependent on the future exchange rate. This will work short term, but will be more challenging to implement over longer time periods. So make sure to take a look at the currency at the country where the firm that you want to invest in is operating, and if the firm is export or import dependent. And analyze whether the exchange rate is likely to change for the worse and what this will do with the firm's earnings. If you think this video has been good so far, feel free to click thumbs up. That would help me out tremendously, guys. Then it's also good to take a look at how the country's economy where the company operates is doing. You may know that economies move in cycles. Sometimes we have a recession, for example, and sometimes we have a boom. And if we can try to predict the financial future of the country where the company operates, this can give us clues to what the future earnings will look like for the company. And there's a whole range of economic data that we can take a look at that shows us how the economy in the country is doing. We have the GDP, of course, then unemployment data. This means, of course, how many people are unemployed in the country at the moment. We can take a look at inflation and interest rates. And the feeling or the sentiment in the country is also important. That is, whether people and companies view the future economic development positively or not. So let's go through these factors in a bit more detail. If the GDP of a country is growing, this tells us that the country has an expanding economy, and then it will be easier for a company to grow as well. If the GDP grows a lot, there might be great opportunities for the companies to increase its sales of its goods and thereby increase its future revenues. While a shrinking GDP means a shrinking economy, and it's of course more difficult for a company to grow in a shrinking economy. In China and India, for example, we've seen higher GDP growth in the recent years than in many countries in Europe, for example. But it's also not necessarily the case that a company will grow faster just because the GDP in a country grows a lot. If a market increases, it can mean an opportunity for the existing companies to grow. But it can also mean that more new companies are started in the same industry instead and filling up the new market segments. How high the unemployment rate is can also tell us how well the country's economy is doing. A higher unemployment rate will mean that the country is not running on full economic capacity. It can be difficult to compare unemployment figures between different countries because these numbers are not always calculated in exactly the same way. But you can compare numbers from the same country at different time points to understand whether the rate is higher or lower at the moment. And then we have the inflation, of course, and this number is also interesting to look at. High inflation means that prices on goods are rising faster. Thus, it can be more difficult for a company to compete on an international market if the inflation in the country is higher than the level is internationally. The company's assets that they can use to buy raw material that they may need are decreasing both nationally and internationally. Within the country, their money becomes less and less valuable, and the same applies internationally, of course. Interest rates also affect companies in several ways. A higher interest rate will make it less attractive to invest to grow the company further, as loans become more expensive. But it will also make things like homes or more expensive goods, such as cars, for example, more difficult to sell when it becomes more expensive for the consumers to lend to buy them. So if the company you're interested in sells any product that counts more as a luxury item and which you usually buy with loans, then this company is more dependent on how the economy is doing in the country. Many companies also have their own loans, and with higher interest rate payments, they will have to pay more to the lender and will of course get less in profit after the interest is paid. the sentiment of the companies and the consumers themselves, or the optimist for the future, will determine how much the consumers are willing to consume, and then for the companies how much of their goods they can sell. A more optimistic consumer will be willing to buy more, while a more pessimistic one will probably instead save more, if they think that the future will be worse and they might need the money then instead. The company's future optimist itself will also determine whether they, for example, want to invest in growing more or perhaps develop a new line of products. If the future is bright and you expect growing sales, it might be a better time to invest to expand your product capacity than if you expect worse times with a shrinking economy. It is important to realize that in order to be able to profit from fundamental analysis and the information that you get out from it, for example, doing an analysis of the global macroeconomic status, you must not only be able to predict the future state of the world, but also predict it better than other investors. As soon as the information becomes known about, for example, that the economy in a country is on the rise and what this means for the individual company, it will be priced into the share price. Anyone who has understood this will of course buy the share directly for the current price and up to the level they have determined to be the new correct or fair value of the company, according to the new changed conditions. The economy in the world or the country affects all companies more or less, but some industries are affected more and some less by the same events. So in the next part of this series in fundamental analysis, we will take a look at what to consider when analyzing a company based on its specific industry. And I've also planned a lot of other content that I will alternate with the fundamental analysis series and that you definitely are not going to want to miss out on. So don't wait any longer, click subscribe and the bell because you can't really afford to miss it. If you found this video valuable, please share it with someone that you think would also appreciate it. Thank you very much for watching all the way to the end, and keep watching these videos appearing on the screen right now or linked in the description box below to learn more about personal finance and how the stock market really works. And I will see you again in the next video. Bye bye guys for now.